Hi, this is Claus Vogt for Money and Markets TV. Last week, Federal Reserve Chairman Ben Bernanke confirmed that he will continue to ignore rising inflation in favor of what he calls pro-growth monetary policy. But this stance will not only lead to more inflation, it will also have grave consequences for the financial markets, the economy, and general welfare. Since Bernanke seems somewhat unaware of it, today I'd like to explain how inflation leads to poverty. During periods of hyperinflation, such as in Germany in the early 20th century or in Zimbabwe just a few years ago, this process happens very quickly. But with relatively moderate inflation rates like we see in the United States, it occurs far more slowly. But in either case, thrift is replaced by theft, leading to a vast reduction in wealth. Let me explain. Through its quantitative easing programs, the central bank is creating money that is not backed by tangible assets. When this money goes into circulation, it doesn't go to consumers, it flows into assets like stocks and commodities. This is the reason behind the recent stock market rally and the huge jump in precious metal prices. Investors who own those assets are the beneficiaries of rising inflation because they were able to buy at the old prices and watch their new assets soar in value. Their wealth grows significantly. And Fed members even brag about this so-called wealth effect. But everyone who doesn't own those assets loses because they are forced to pay higher prices. So the relatively small group of asset holders becomes richer, while those depending on fixed incomes or earning low wages get poorer. The longer this easy money policy keeps going, the wider the gap between the haves and have-nots. We are seeing this trend play out all over the world, but especially so in the United States. Today, the super rich hold a far greater share of total wealth than just a few years ago. This is not always a bad thing. Sometimes wealth is created through great inventions or products that make the world a better place. In those cases, this entrepreneurial effort should be rewarded in order to propel progress and wealth accumulation. But that's not what's happening now. Today, there is no connection between effort and reward. Instead, the government is bloating the money supply and rich rewards are being lavished on those who contribute little value to society. Speculation, not innovation, is being rewarded in this inflationary environment. We can see this by looking at the chart of real interest rates, which have fallen back below zero. This means that people who are saving money are actually losing buying power. So it's no surprise that the US savings rate has dropped to historically low levels over the past decade or so. The savings rate did pick up quite a bit during the last recession, but it's still nowhere near the healthy levels we saw last time in the 1980s. Savings are important. They are the source of real investments and the basis of wealth creation. But our politicians and central bankers seem to have forgotten that. They are doing everything in their power to discourage saving and encourage risk-taking and speculation. In the process, they are creating more asset bubbles and ignoring the damage caused by previous ones. But their easy money policies also represent a fundamental assault on society. They create extreme income inequality that threatens to disrupt the social harmony that's supposed to be a hallmark of so-called Keynesian economics theory. Now, the question becomes, what should you do about it? Ben Bernanke has made clear that money printing will be with us as long as he is in control. This tells me that the secular bull market in gold will continue. Therefore, I still recommend gold bullion and gold ETFs such as SPDR Gold Shares, ticker symbol GLD. Of course, there will be corrections from time to time, even severe ones. However, these corrections should be greeted as longer-term buying opportunities. I'm Claus Vogt for Money and Markets TV. Thanks for watching.